Good afternoon, boys and girls. It's the weekly wrap up for February 18th, 2022. I hope everyone's had a good week. It's been pretty nice here in Colorado. Have mostly sunny days. We did get a snowstorm that came through Wednesday night into yesterday morning, but it wasn't too bad. There wasn't too much snow on the driveway that I had to clear. So it all in all wasn't too bad. It was my birthday this week, which was great. Somehow made it to 48 years old. So, and then I'm also reminded that I am 48 because my back's been acting up all week and it's been pretty miserable. So anyway, so you got to take the good and the bad. So, all in all, I got a blessed life. Life is really great. So can't complain too much. All right. Well, if it's your first time here, please click on the little subscribe button over here, or might be over here somewhere. I don't know. And also like and share with friends and family. I would greatly appreciate it because I try to keep this pretty informal and talk like I would just to anybody else. I'm trying to keep the jargon down to a minimum. So, all right, well, let's go ahead and jump in and see how the indexes did today. Dow Jones was down 0.68%, closing at 34,079. S&P 500 down 0.72, closed at 4348. NASDAQ looks like it had the worst of the day, down 1.23, closing at 13,548. Small caps are also down about 1%. The VIX actually receded 1.28% today, so that's pretty good, closing at 2775. And let's see. Let's go across. We got Canada, into Europe, nothing but red. Let's see, about the worst of it was the DAX and the OMX C25, which is out of Denmark, and Russia was down 3.35% and 4% in their markets. We do have one up market here. This looks like Turkey was up 1%. Then again, more downs. New Zealand and Australia were down. But the Chinese markets appeared to be up. Shanghai, the SE component was up. China A50 and the DJ Shanghai, all of those were up. The Hang Seng was the only Chinese market down, and then it's kind of mixed in the other smaller Asian markets. So, looking at things across the globe for February 18th, it looks like it started pretty good. Nothing too dramatic. 0.25%, 0.5% up over in Asia, and then it looks like it kind of just fell apart with Eastern, Western Europe, and here in the U.S. So, not the end of the world. These things do happen. So let's take a peek and see how the Dow did for the week. Dow Jones was down about 175 for the week. S&P 500 looks like it was down about 145. NASDAQ looks like it was down about 173. Dow Transports barely down 0.33, and the Dow Utilities finished off the week down 0.96. So domestically, it looks like everything was in the red. So let's take a peek and pull out at the larger trend and see where things are going. So let me add in my resistance lines here, so you can see since. Really last, August, September last year, really, since we broke this major trend line in the late summer, really just kind of been, dilly-dallying kind of sideways here. Let me drag this down a little bit. So you can see we reached this line of resistance here, and then it'll drop back down. Same thing, we have this resistance line here, and it'll pop back up. So, the curious thing, to watch right now is to see whether or not it's going to go through either one of these points of resistance. If it goes up through the higher side, that would lead us to believe that, more of an uptrend or an up momentum in the market is on our way. If it breaks through this resistance line here on the bottom, it, typically is a sign that the markets are headed in a negative direction. So, it's tough to tell. I mean, looking at the momentum indicator, MACD, it's been in the red since January 24th. But again, it hasn't really gone too far. I mean, we have just 2 years ago. We can look back and see what it looks like when it blasts through that line. It's a very good indicator of where the market's going. But I mean, you can see here going back to last fall, I mean, it's just kind of just kind of cruising along up and down, just kind of torturing me. Is it going to go, the market going to go down? Is it going to go up? Which way is the momentum heading? So anyways, yeah, it's, it can be a little aggravating, watching these charts. All right, well, let's take a look at some of the economic data that came out this week. Initial jobless claims came in at 248,000 against the forecast of 219. Last week's numbers were revised up 2,000 from 223 to 225. Still below last week's forecast, so that's certainly positive news. Continuing jobless claims came in at 1.593 million. Forecast was 1.605. So again, came in below forecast. Pretty good. Last week's numbers were revised down 2,000 from 1.621 to 1.619. All right. Producer price index year over year. Prices are up now as of January's numbers, up 9.7% year over year. The forecast was 9.1. Not ideal. So again, we can see this slow creep, really started, where did it get really bad? Probably last March. So we're almost a year into this where the inflation has gone over 2% and has been pretty stable, or pretty consistent, staying above that number. All right. Core producer price index, that takes out things like food and energy, because who doesn't want to eat or drive their car? I know. We can just live without those things. I'll just, we'll buy clothes and, electronics and starve in our houses. It's up 8.3%. Forecast was 7.9. So it did recede a little bit from the previous month. Last month's numbers were, what was this, 8.5, and then this is 8.3. So again, it's certainly not the end of the world, but it is, it is going to weigh on our pocketbooks. It's just going to become the new norm, like, back in the 70s when, early 70s, the average income of an American was like $10,000 a year, which that was good money. I mean, you could take care of a family on that, have a house, have a car or two. Your wife could stay home and not have to work. But by 1980, the average income was $30,000 a year. So it wasn't because wages went up. It's because inflation was just such a mess. And, so is this going to be the new norm? I don't know. All right. Retail sales year over year came in at 12.96. The previous was 16.71. So we do see that little bit of a receding in the retail sales number. Again, not the end of the world. Excuse me. Those darn frogs. All right. U.S. industrial production year over year came in at a 4.8 or 4.08 number. Last month's number was 3.8. So it looks like production has increased a little bit. Housing starts came in at 1.638 million. The forecast was 1.7 million. So slightly off from from the forecast and slightly down from last month's number of 1.702. But, it is the middle of the winter. Building houses isn't always the easiest when you live north of Dallas. So, if you live in Florida, you can build houses year round. It's the summertime that's the worst, not the winter. But existing home sales came in at 6.5 million. The forecast was 6.1. Obviously, the existing home market has been hot. So over the last year since, or really the last two, as people have been trying to leave the blue cities, which are pits of hell. And I don't blame him. I live out in the middle of the woods for a good reason, so I don't have to deal with morons. All right. The U.S. leading index of leading economic indicators, this came in at, or leading index month over month came in down 0.3%. We were forecasting a plus 2.2. So again, off by about 0.5% the wrong way. We'll see if this is going to be a longer term trend, if it's just more of a little bit of a lag, because we had some pretty consistent numbers, the last 4, 5, 6 months. So, all right. And the oil rig number, everybody likes to know about this. The Baker Hughes rig count is up to 520. Last week's was 516. So we added 4 more rigs to capacity. I would feel a lot better if that number was 600 or 700. I think that would add some real reduce a lot of the strain on the oil companies and the refiners. If we have more oil, we can refine it faster and get it out to the public. But yeah, we'll see. All right. So this is an article from Barron's. It's kind of a daily recap. I thought this would be a good article to review of what happened in today's market. The Dow fell, Roku tumbled, and what else happened in the stock market today, written by Jacob Schonenstein and Jack Denton. Stocks ended Friday down as investors kept a close eye on the growing tensions between Russia and Ukraine. The Dow fell 233 points. The S&P 500 dropped down 0.7. NASDAQ was down 1.2. Yeah, we already know all that. There's enough fear that Putin may move on Ukraine right after the Beijing Winter Olympics are over. That caution is keeping the dip buyers at bay, wrote Louis Navier, founder of Navier and Associates. The good news, there was diplomatic progress on the Russia-Ukraine front. Secretary of State Antony Blinken and Russian Foreign Minister Sergei Lavrov are set to meet next week. President Joe Biden will communicate with allies. Well, that's good news. It's good to know Joe is on top of it. Moron. The bad news: Russian President Vladimir Putin told reporters Friday that the situation is deteriorating, plus shelling intensified in Ukraine, according to the Wall Street Journal. Now, that shelling that we've been hearing about, I think hasn't been from Russia. It's been from pro-Russia rebels, as they like to call them, inside of Ukraine, squabbling with, I guess, the national army there. So, it's a domestic problem at this point. So I wouldn't get your hackles all up. On Thursday, the market dropped. The S&P 500 and NASDAQ fell more than 2%, and the Dow had its worst day in a year. Investors were reacting to two developments. Blinken told the United Nations Security Council that Russia is likely to invade Ukraine within the next few days. Wait, I thought it was supposed to be on the 16th. Oh, anyways. And the West warned that Russia was still building up troops near Ukraine. A concern about war is that Russia, one of the world's largest oil producers, would see supply disrupted, mostly likely by sanctions that would cause oil prices to spike, hurting consumers who already are struggling with inflation. The price of WTI fell 0.2% Friday to below $92 a barrel. The commodity is still up 21% for the year, but down from its highs of $95.82 earlier in the week. Buyers have stepped in at $89 a barrel in light of the Russia issue. The move down in oil, though, is partly because markets have been in risk-off mode. Market participants have been moving into safer assets to ride out volatility and riskier assets like stocks and oil contracts. The price of the 10-year Treasury note rose, sending the yield down to 1.93 from a Thursday close of 1.96 and down from its pandemic-era peak of 2%. Markets are still far from an all-clear signal. Equity and oil prices could easily bounce around, seemingly indecisively, until the Fed releases its interest rate decision in mid-March. I'm sorry, if it's anything less than 0.5% interest rate increase, I think that'll throw the markets into a tailspin. Markets are expecting 1 or 2 rate hikes, but we'll be listening for cues on how many rate increases are coming later in the year. I think what that really boils down to is the bankers are worried they're not going to be able to loan out more money at super low interest rates, and that's going to put a crimp in their lending. And so within the market, tech stocks were faring poorly, with the Nasdaq the only of the 3 major indexes still in correction territory. The correction is defined by a 10% drop or more. The selling in the sector just may not be over. The index's 50-day moving average is now a touch below its 200-day average, which means investors are repricing tech stocks so drastically that the Nasdaq recent price average is now below a longer-term average. Rising bond yields. Overall, the main culprit, yields could still move higher from here, as the 10-year Treasury yield is still below the expected annual inflation rate for the longer term. Higher bond yields make future profits less valuable, and many tech companies are valued on the basis of sizable profits many years down the line. Overseas, the pan-European stock 600 ticked down 0.8. In Asia, Hong Kong's Hang Seng was down 1.88, closed out the week with a daily loss of 1.9. with Boris's in the region taking cues from Wall Street's dismal Thursday trading. All right. So, kind of an ugly week. It's not the best, not the worst. I think a lot of us are just kind of in a waiting mode, waiting to see what the Fed's going to do in the next at the next meeting next month. It's to me, it's clear as day. It would only make sense to raise interest rates, but again, there's a lot of pressure from those who make money off of making loans, and the higher the interest rates, the less loans those banks get to provide. All right, little congressional news here. U.S. Congress passes sends Biden's stopgap funding bill to avoid a government shutdown. That would be terrible if that happened. The Congress on Thursday gave final approval of legislation funding the government through March 11th, avoiding the embarrassing spectacle of federal agencies having to shut many of their operations amid the Russia-Ukraine crisis. Yeah, because it'd be terrible if the Parks Department wasn't open. The Senate acted as a midnight Friday deadline loomed when existing funds were set to expire for operating most of the federal government. The temporary funding bill, in a bipartisan vote of 65 to 27, that doesn't total 100, and now goes on to let's see here, to President Joe Biden for signing into law. It was needed because Congress so far has failed to pass any of the 12 regular appropriations bills for the fiscal year that began on October 1st. The government shutdown would be useless, senseless. Can you imagine how that would look to the Russians? Oh my God, they would make fun of us. I mean, not that being broke and in massive debt isn't enough to point their fingers at the Uncle Sam's retarded army in Washington and figure out that they don't know what they're doing. All right, jumping back in. This third stopgap measure since last September, which the House of Representatives passed on February 8th, would give congressional Democrats and Republicans until March 11th to reach a deal on massive spending bill to keep Washington humming through September 30th, the end of the current fiscal year. The prolonged uncertainty over Washington's finances for operations, including many military programs, comes at a time when Russia has amassed around 150,000 troops at its border with Ukraine, stoking fears of a looming invasion that has rattled NATO nations and financial markets. House Senate negotiations on a spending deal likely would appropriate around $1.5 trillion in discretionary funds used for an array of government programs, including those administered by the Pentagon, the EPA, Health and Human Services, and other cabinet-level departments. Most of those are unconstitutional, so we should probably fire everyone in those departments. Failure to reach a deal by March 11th would leave Congress with three options: simply passing a bill extending current funding at levels approved by the former President Donald Trump's administration for the remainder of the fiscal year, approving a fourth temporary bill in the hopes that a grand deal can still be negotiated, or letting funding lapse. The latter would trigger widespread furloughs of federal workers, shuttering many programs. Well, I mean, who cares? Federal workers don't do much work anyways. I mean, most of them are like government jobs like the post office. I mean, come on. Hey, and again, I can complain about the government. I worked for them for 4 years. I know how the retards who are running things there. You got a lot of hard workers, E5, E4 and below. They're the ones who do all the work. All the top heavy khaki staff, you could probably terminate 2/3 of them in the military, still run just fine. A long-term extension. Who's calling me there? Long-term extension of current funding would cause some Pentagon layoffs, for example, and freeze National Institutes of Health funding for medical research at a time when the COVID-19 pandemic raged. Okay, it's not raging on. And you could probably fire Fauci because he's done nothing but be incorrect most of this time. The last time Congress failed to fund the government was in December of 2018, when Democrats balked at funding then President Donald Trump's U.S.-Mexico border wall. Following a record 35-day impasse, Trump found ways to partially circumvent Congress, but the so-called wall never was completed amid skepticism over its effectiveness. We don't need a wall. We just need some hunters out there. You shoot those wetbacks as they come across the border, problem solved. This time around, Republicans are insisting that overall spending will be split evenly between defense and non-defense programs. Democrats, who narrowly control Congress, have been seeking slightly more spending in the non-defense arena. All right. Okay. And one last article I got here. God damn, I've already gone 20 minutes. How will the stock market respond to a 0.5% rate increase? Again, if you were to read these articles out here, you would think that they were going to raise rates to 20%. I So everybody's like, oh my God, it's just going to be so terrible. All right, let's see what Investors Business Daily has to say about this. It's from Michael Molinsky. Federal Reserve is considering an interest rate hike at its March meeting that could be as high as 0.5%. We haven't had a rate increase that high since the dot-com bust in 2000. Again, they're not asking for much. If we did a 0.5 point rate hike, how would the stock market perform? Let's see. The consumer price index rose 0.6 in January from the prior month and 7.5% versus a year ago. The biggest annual gain since February of 1982. Rising inflation prompted the Federal Reserve to turn more hawkish. Treasury yields jumped, and the stock market, particularly the tech sector, took a beating. As of Tuesday, the odds for a rate hike of 0.25 point to 0.5% was 42%, compared with 58% for an increase of 0.5 to 0.75%, according to the CME Group Fed Watch tool, which tracks interest rate futures. But on Thursday, the odds for a 0.25 point hike were higher than for a 0.5 point increase. All right, market performance and interest rate hikes. A study conducted by Dow Jones Market Data analyzed how markets reacted to the last 5 interest rate hikes of 0.5% or more, both before the hikes were announced and in the weeks and months that followed. The results are below. So you can see here the Dow Jones, the S&P, the NASDAQ, and the Russell 2000. And the 4 weeks before the hike, you can see that markets were slightly down in some cases. Looks like the NASDAQ took it the worst. That is not unexpected since tech stocks are very interest rate sensitive. And looks like the Russell 2000 was also down a little bit. But then coming out of it, let's look at 2 months later. The Dow Jones was up 3.3. The S&P was up 2.85. NASDAQ, which was down early, is up 6.22. And then the Russell 2000 is up a little more than 3.5. So let's go a year out. The Dow Jones Industrial Average was up 22.48. S&P 17.52. The NASDAQ cooled down, was only up 18.74. And the Russell 2000 15.58. So I guess what we can glean from this is that, certainly not the end of the world that interest rates are going to go up. You'll actually get paid to save, put your money in a savings account. Won't that be nice again? So there's a little more text here, but I'll let you read it at your own leisure. So like I said, wouldn't it be nice to put some money in the bank and have the bank pay you for being a saver again? I know I would like that. And, it's going to be a bit of a damper on the stock market, on the overcharged tech stocks who, seem to do really, really well when interest rates are at or near zero. So, but, in the end, whether or not the government falls apart or they crash the dollar, life will go on. The most important thing is to have real assets, whether or not it's gold, silver, stocks, bonds, things that are tangible. And if you're going to invest in stocks and bonds, make sure you're investing in things that are quality companies that make money. Investing in a company that, it has a lot of growth upside, but they lose money every year. That's not always the best way to go. And personally, anytime we go through a downturn, usually those are the ones that suffer the worst. So anyways, all right. Well, if anyone has any worries about what's going on in the world, don't hesitate to, drop me an email or give me a phone call. I'd be happy to sit down for 30, 40 minutes and talk about what's going on, maybe talk about your situation. But anyways, all right. Well, that's everything I had for today. I hope everyone has a fantastic weekend. I think we have a holiday on Monday. I believe it's President's Day. I am not totally sure if the markets are open or closed. Some might and some might not. But I'll be here with the weekly economic update and any news that occurred over the weekend. And hope everyone has a great evening and a great weekend. Bye-bye.